Hi, welcome back. You're watching Trading Hour for the market. We're about over 0.5% higher now for the frontline indices. The mid-cap index having a field day. So all in all, it's a good day of trade so far. Sunil Subramaniam, Managing Director and Chief Executive Officer at Sundaram Mutual Fund, joins in now to talk about the market. Hi, Sunil. First of all, very good to see you in person after a gap of 2 years, I think.
Absolutely.
And these 2 years have really been, quite volatile for the market. We've seen good days and how, and then there are the bad days. From here, do you expect much more volatility, or do you think the worst of it is done at least?
I think that there will be much more volatility, but I wouldn't attribute the term worst to volatility. Okay. So there will be good days and bad days. So people generally tend to treat volatility as a bear market. No, right? So
it's an opportunity.
It's an opportunity. No, it's an opportunity for a long-term investor. But the problem is the long-term investor of 3 years back, what does he do now? Because he's finished his long-term, so to speak, in 4 to 5 years. So I would say that, see, there are three things here, right? There's liquidity, there's news, and there's actual data on the economy, right? So the blend of the three are the ones that cause volatility. And liquidity is in a very interesting space because I think the central bankers got it wrong. In terms of the tapering, they started it too late and now they've caused a recession. They caused a demand growth first through their liquidity, and now they have, with the not acting on the inflation, they're causing the recession. So it's actually central bankers have realized that, I'm not talking about India, India has done a fabulous job. So why I'm saying the volatility continues, because now they are what I like to use a Hindi term called Trishanku Sargam. Why is that? In a stagflation scenario, neither you can hike rates nor cut rates. So, right, neither you can put in liquidity nor withdraw liquidity. So, central banker is powerless. He now has to wait for data, and now he has to act only after data. He cannot tilt the balance of inflation with growth either way, right? So, because the data coming then is, nobody predicts the data, it's so uncertain, the volatility will be there because the news on the data will then get people to predict the central bankers rate. So period of volatility is going to be certain for about 6 months time, I would say. And then there will be a good degree of clarity emerging, because if the central bankers see that either inflation is winning or growth is winning, see, that's what they want, and not a hung parliament, so to speak. They can then decisively act.
Okay, all right. Sunil started off by saying that volatility sometimes provides an opportunity as well for people to build a portfolio with a longer time frame, right? And we're likely to see quite a bit of volatility going by what the global central bankers are doing. We'll have to keep an eye out on the Reserve Bank of India as well. If some allocation needs to be done, to equities, then where?
So I would say that a broad India-focused allocation. So when I say broad, it's across the cap curve. But keep your focus on India, because the one certainty about the whole thing is that India is going to have a high digit growth rate. Now, it may be 7, it may be 9, depending on how it pans out, but you're not going to see India go to 2% growth rate. So what is the certainty that India is going to grow? Second, how is that growth going to happen? It's going to be supply driven, right? Either from a government infra spend, or from a PLI driven capex spend, or from an export substitution part, right? Now, in addition to China substitution, Russia substitution has become a play. So it's all going to be capacity creation, supply driven. So the degree of certainty behind that is far greater, because government has got a good fiscal situation to continue to support infra. Bank interest rates are still decent, that corporates can borrow and invest. So the conducive nature of an Indian growth story, one. Second is on the inflation, right? Europe and US are at the same rates of inflation as India, but that is 3x their growth rates, and that is 3x their historic inflation rates. Whereas for India, we are at probably 2003 to 8, our boom time. Inflation was roughly the same as now. So while it's higher than in the past, because we have come from a COVID scenario, this 6 to 7 is not a very unusual inflation rate for India. So the inflation plus growth outlook being confident, so the story is of India. So you allocate then to India. Now, whether you buy large caps in India, mid caps or small caps, it depends. If you are buying the banks, I would say buy larger cap banks. If you're buying the capital goods supply story, you buy the mid and small cap. So I would say a broad India-based market allocation is probably the right thing. And the next 6 months is the best time to buy because the large caps are facing selling pressure from FIIs. So there is correction. The mid caps are facing that pressure because you need only 10% of the flow out to happen for the same price correction in a mid cap. Yeah. So while the story on mid caps is not bad, the price action is very bad. So actually it represents good opportunities to accumulate quality stocks. And I would end by saying that the definition of quality has also undergone a change from the last 2 years to now. 2 years COVID, post-COVID, quality was defined as safety. That is where you are certain that there is going to be some degree of growth, like an FMCG pack or IT pack. Today, quality is certainty of growth revival and not safety. So I would say that, so in your allocation, your safety lies in buying growth. And it's a slightly contradict on what I'm saying.
Understood.
So I think that's the story. So if you want to do that now, allocate in a multi-cap kind of space and allocate staggered over the next 6 months.
But the only problem is people have been buying the dip so much that they've run out of money to buy a further dip. But anyway, let me ask you something closer home, right? The mutual fund industry, because over the last 2 years, we have seen such a tremendous growth, right? But now, we have seen a case come to light of a top-tier company where the allegations as of now of, insider trading to people have been terminated. The employment has been terminated. Do you think these will cast some sort of a shadow on flows going forward?
Not at all. Absolutely not at all. I mean, if you look at scams as such, right? Capital markets has seen so many scams. Banking industry has seen so many scams. Have you seen people lose faith in the system? No. I think that rogue traders, greed of individuals are always system risks which happen. But I think overall, if you see as a regulator, I would rate SEBI as among the top in the world in terms of the checks and balances and the correction mechanism. So such events, while they cannot be prevented, they will not become a conflagration because of the broad nature of risk control, which is very, very solid. So I would say that I don't expect any of these to be fairly well controlled. I think even the particular thing, immediate action has been taken, demonstrated. So I don't see this as a loss of faith in the mutual fund industry or any such thing. On the contrary, you will see that the fact that this has been contained will give us renewed strength that such things are not something which will hurt, I would say.
Okay, all right, Sunil. Thanks so much for stopping by, filling us in with your view. It's good to have a guest in the studio after a long, long while. We finally feel things are normalizing, and the score with the worst of it is. Look forward to chatting up with you rather soon. For the time being, though, we'll slip into a short break. You come back, and we'll get chatting with the new kid on the block that's part of the phosphates. Remember, the company listed earlier today.